This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. Welcome to Valuing Gifts of Property, Part 2, Examples. This is Professor Russell James. Now consider some examples that demonstrate how these rules function with specific gifts. Suppose that a donor owns a share of stock that he paid $1 for in 1990, which today is worth $25. He gives that share of stock to a public charity. How much could he deduct for that charitable gift? Notice that the stock is long-term capital gain property. Why? First, it has gone up in value, therefore it is gain property. Second, the donor has owned it since 1990. This means he has owned it for more than 12 months, and therefore it is long-term capital gain property. Because it is long-term capital gain property, this means that the donor can deduct its fair market value, in this case $25, unless one of the three exceptions applies. In this case, none of the three exceptions apply. The donor is not giving the property to a private foundation, but instead is giving it to a public charity. The donor has not made a special election to reduce the valuation, so that exception does not apply. And finally, this is intangible personal property, therefore the third exception, which relates to tangible personal property, does not apply. Because none of the three exceptions apply, the donor can deduct this gift at its fair market value of $25. Now suppose the donor has farmland that he purchased for $600 an acre in 1990, which is now worth $1,800 an acre. He contributes this farmland as a gift to a private foundation. How much per acre can he deduct for this gift? As before, we begin by recognizing that this is long-term capital gain property. First, it has gone up in value. Second, the donor has owned it for more than 12 months. Because this is long-term capital gain property, the donor can normally deduct its fair market value unless one of the exceptions applies. The donor has not made a special election to have his gift's valuation lowered, so that exception does not apply. Similarly, this is not tangible personal property. It is real property. Therefore, the tangible personal property exception does not apply either. However, the donor has made this gift to a private foundation. Consequently, he will not be able to deduct its fair market value unless it is, quote, qualified stock. Clearly, this is not any type of stock shares because it is real property. So the exception to the exception is not relevant. As a result of making this gift to a private foundation, since it is not qualified stock, the donor's deduction for the charitable gift of land will be limited to its cost basis. In this case, that means that the donor's deduction will be limited to $600 per acre. Next, consider an example involving a different kind of property. Suppose a donor purchased an antique toy car 6 weeks ago for $1. This was quite a good purchase because today the value of the antique toy car is $25. The donor's plan is to give the toy car to a museum of toys that is also a public charity. The charity is interested in the car for its historical value and intends to display the car in its museum collection. How much can the donor deduct for the gift of the antique toy car given to the public charity? The answer to this question is actually simpler than it may seem at first. Because the donor has owned the antique toy car for only 6 weeks, it is short-term capital gain. Because it is short-term capital gain, the rules concerning related use or unrelated use, tangible personal property, become irrelevant. The gift must be valued at the lower of fair market value or basis, regardless of its usage by the charity. These exceptions are irrelevant because, as short-term capital gain property, this item may be valued only at cost basis. As always, valuing at cost basis assumes that the cost basis is less than fair market value. Here, the cost basis of $1 is less than the fair market value of $25. Now consider a slightly different example. Suppose the donor purchased the antique toy car not 6 weeks ago, but in 1990. How does this change the result? To begin with, since the donor has owned the property for more than 12 months and it has gone up in value, this property is long-term capital gain. Because this is long-term capital gain property, there is the potential to deduct the full fair market value of the gifted property rather than only its cost basis. Of course, this is true only if none of the exceptions apply. The first exception does not apply because this is not a gift to a private foundation. It is a gift to a public charity, in this case a museum of toys. Next, there was no mention of a special election, so this exception does not apply either. Finally, this is tangible personal property, and consequently the unrelated use exception could apply. However, in this case, the charity will actually be using the gifted item in furtherance of its charitable purposes. Thus, this property is related use property, not unrelated use property. Because none of the exceptions apply, the donor is allowed to deduct the full fair market value of the property donated to the charity. In this case, it is important that the charity intended to use the item in its charitable operations by displaying the toy in its collection. How can the IRS prevent abuse of this rule by charities that might say they, quote, intend to use the gifts of property, but then simply sell the gifted property? In this case, abuse is limited by the recapture rule. If a charity sells or otherwise transfers the property item within 3 years, the valuation could change from fair market value to cost basis. Such a change of valuation would require the donor to amend his or her tax return to reflect the lower deduction. This recapture rule applies only to tangible personal property worth more than $5,000. The IRS does not want to hassle with recapture for small gifts. But for these larger gifts, a transfer or sale of the property by the charity within 3 years will lead to the reduced valuation for the charitable deduction. This occurs unless the charity certifies that it made substantial related use of the property prior to sale, or that the intended use became impossible. For example, if the donor's toy car were worth $25,000 instead of $25, and the charity sold the toy 3 months later, then the original deduction would be subject to recapture. However, if the reason the charity sold the car was because their museum location burnt down, making it impossible to display the car as originally intended, then no recapture would be required, assuming that the charity certified that the original intended use became impossible. Alternatively, if the charity had, for example, displayed the car for 2.5 years in its collection prior to the sale of the item, and it was willing to certify this substantial related use, this certification could also prevent recapture. Obviously, the simplest and cleanest way to avoid recapture is to make sure the charity does not sell the item for at least 3 years. If the charity does sell within 3 years, but it also certifies that one of these 2 exceptions applies, that will also avoid recapture. However, this certification must be accurate. The charity must sign under penalty of perjury, and there is a $10,000 fine if the charity provides false information. So what happens if the charity does not use the item, but instead simply sells it soon after receiving it? In this case, the donor gives his antique toy car to a public charity that displays toys in its museum, but the charity doesn't want to display the donor's toy. The charity just wants to sell it. So after the donor has given the toy to the charity sells the toy at its annual benefit auction. What happens then? Once again, this is still long-term capital gain property because the donor has owned it since 1990 and it has gone up in value. Because this is long-term capital gain property, there is at least the possibility that it could be valued at fair market value unless one of the exceptions applies. In this case, one of the exceptions does indeed apply because this is unrelated use tangible personal property. It is unrelated use property because the charity did not use it. Instead, the charity simply sold it for money. It is tangible personal property because it is a movable physical item. Thus, this tangible personal property is not being used by the charity, but is instead simply being sold. And thus the exception to fair market valuation does apply. Because one of the exceptions applies, the donor cannot use the fair market value for calculating the deduction. Instead, the valuation must drop down to the cost basis valuation. So the gift of an item worth $25 generates a deduction of only $1. An exception to the exception is the rule related to, quote, qualified stock. Qualified stock is typical publicly traded stock. That is, stocks that are traded on an exchange such that market quotations are regularly available. For example, any stock traded on the New York Stock Exchange can be qualified stock. In addition to being a publicly traded stock, the private foundation cannot have more than 10% of the entire company when counting all family member transfers together. What is the thought behind this rule? The intent is to avoid giving special benefit to large, closely held insider transactions. Consider the case of a family-owned business where family members transfer most shares of the business to their own private family foundation. This transaction has some potential for abuse. The family members controlled the asset before the gift, and now, as board members of the private family foundation, they control the asset after the gift, at least until it's sold. Determining the fair market value of shares in a family-owned business may be quite difficult. This is especially true for closely held corporations where other investors may be uninterested in owning a minority share when the family still controls all aspects of the business. Because private family foundations are often controlled by the donor or the donor's family, these transfers are generally less desirable than gifts to traditional public charities. The exception is allowed for cases in which the property given is almost like cash. It is almost like cash because the shares are regularly traded and have an easily identifiable value. It is also like cash because it is not a very large share of the total ownership of the corporation, even when considering all family members' transfers together. Given the cash-like nature of the transfer, there is less concern about inappropriate or abusive transactions, making a fair market value deduction more appropriate. Let's look at an example of the mechanics of this kind of transaction. Suppose a donor owns 10,000 shares of Microsoft Corporation, a publicly traded corporation, which she originally paid $1 per share for and is today worth $25 per share. The donor gives these 10,000 shares to a private foundation. What is her deduction for this gift? Initially, it is useful to note that this is long-term capital gain property. This is true because the donor has owned it for more than 12 months and it has gone up in value. Because it is long-term capital gain property, there is at least the potential that the donor can deduct its fair market value, unless one of the exceptions apply. In this case, the donor is giving the property to a private foundation, so one of the exceptions to a fair market value deduction does apply, unless the donor qualifies for the exception to the exception. Because the donor is giving qualified stock, the normal rule for private foundations does not apply. As a result, the donor is allowed to deduct the fair market value of the shares of stock. Thus, the donor's deduction is $25 per share, that is $250,000, rather than $1 per share, that is $10,000. The property is qualified stock because it was publicly traded, meaning that market quotations are available, and because 10,000 shares is nowhere close to 10% ownership in the corporation, given that it has billions of shares. This has been Valuing Gifts of Property, Part 2, Examples. Join us next time for Valuing Gifts of Property, Part 3, Special Assets.